Taxes are not fun to pay, and you can't really get around it. Especially when you're in the realm of cryptocurrencies, there will be taxes involved. However, there are some cool strategies you can keep in mind moving forward that help you reduce your taxable amount. In fact, you'll know a few ways that you can actually pay 0% tax on your crypto gains. Welcome to Whiteboard Crypto, the #1 YouTube channel for crypto education, and here we explain topics of the cryptocurrency world using analogies, stories, and examples so that even your grandpa could understand them. In this video, we're going to be explaining how to legally avoid paying your taxes on your cryptocurrency gains. Let's dig in. Now, before we get too far into this topic, I want to explain what I mean when I say avoiding taxes, because there is a difference between evading and avoiding. Evading is the act of using illegal methods to pay less taxes. Avoiding, on the other hand, is using legal methods like loopholes or technicalities to avoid paying those taxes. For example, if I bought a new car and I said it was for Whiteboard Crypto, that would be evading. That would probably fall under tax evasion. However, if I bought a new $3,000 computer and only used it when I was creating more videos, that would be avoiding, because I could use the $3,000 computer as a legal deduction. In short, one is legal, the other is not. In this video, I'm going to be covering mostly the legal ways, but I'll also cover some illegal ways so that you know what not to do. Or, well, that's at least my intention. I'm just here to share information. The simplest advice to avoid tax is to just not sell. Right now, at least in the United States, crypto is treated as property, and so you're only taxed whenever you sell your crypto and realize a gain or a loss. If you made money, the government wants their fair share, and if you lost money, well, hopefully you can use that to offset some of your other gains. So for example, if you made 100 grand on one coin and then you lost 80 grand on another coin, technically you should only owe taxes on around $20,000 of gains that year. By not selling your crypto, you actually owe 0 taxes on it. Hopefully, if you've invested in a project you believe in long term, then you have no problem waiting to sell. The best advantage of waiting to sell is that there may be a day in the future where a new crypto law is passed where we don't have to pay any taxes, or maybe even that we're just taxed in a more advantageous way. Personally, this sounds unlikely to happen soon, so I'm going to share with you another reason why holding onto your crypto can help your tax bill. In the United States, we have 2 classes of taxes, at least for things considered property. Crypto does fall into this category, so it falls into these 2 classes. The first is called short-term capital gains. The capital gains is a fancy word meaning you made money by buying something and then selling it. And the short-term part means that you owned the property, or crypto, for less than 1 year. By holding it less than a year before selling, technically, you owe a higher tax rate on it. Here's the chart of the current 2021 short-term capital gains tax rate. Now, if you hold your crypto for longer than a year, it falls into the second category called long-term capital gains. Whenever you hold your property, or crypto, for longer than 1 year, it gets taxed at a different, actually better tax rate. So holding from day 300 to day 366 can actually save you quite a bit on your taxes. Just keep this in mind. Here's an image of the 2021 long-term capital gains tax rate compared to the short-term capital gains tax rate. Do you see the difference? If you're already a millionaire, you've probably already seen this once or twice in your life. Moving on with this, one thing to note about taxes is that when it comes to crypto, any trade that you make is also a taxable event. Now, this is definitely true when you trade on an exchange like Binance or Coinbase. They will collect your information, including your trades, and send that information to the IRS, who will then be knocking at your door if you don't explain to them whenever you're reporting your taxes. Now, trades on decentralized exchanges like Uniswap or PancakeSwap, they don't collect your personal information. However, it's still considered a taxable event. This means if I trade my Ethereum to Shiba Inu on Uniswap, then technically the IRS says that I'm actually selling my Ethereum and buying Shiba Inu. And because of this, I should be taxed like it. Now, the thing here is that since decentralized exchanges don't collect user information and then send it to the IRS, then technically, the trades that happen on it are the user's responsibility to keep track of and report. If you do not report them, then the IRS may never know about it. But that's not financial advice. Unless you give the IRS a reason to start looking around, they are currently quite underfunded. It's also worth noting that they're actually developing crypto tracking software, so I don't want to scare you, but I also don't want to give you the green light to do some sketchy things on your taxes. The next thing you can do to avoid some crypto taxes is to simply get a loan on them. Just like a house, whenever you get a mortgage, the house is the thing that is backing the loan. So if you get a car loan, the car is what's backing it. And you can do the exact same thing with crypto. The thing here though is that the this loan is technically not taxed. It means that you can access the value of your crypto without needing to outright sell it. Also, bonus points of what you're borrowing against is crypto that you believe in, so that you can access the value tax-free while also letting that crypto grow in value. Now, there are many ways to do this, but you have to be careful whenever you set it up. It's usually quite simple, but most people don't even know it's something they can do to avoid taxes. Now it's time to get into the more complicated things. Next up is a crypto Roth IRA. So a Roth IRA is actually a traditional finance tool. First, let me explain the IRA part. So none of this is financial advice, but IRA stands for Individual Retirement Account. And this is a tool that you can use to get a tax cut for money that you invest specifically for your own retirement. The default, original IRA is called a traditional IRA, and here's how it works. Let's say you invest $5,000, and it grows to $20,000 by the time you retire. Well, technically, that first $5,000 that you invested, you get a write-off on your own personal income tax, which means however much money you owe taxes on to the government, they basically say, subtract $5,000 from it, we don't want taxes on that yet. Then, whenever you go to actually take some of the money out because you're retired, you pay taxes on that. So let's say you're already retired and you want to take out $4,000 of the $20,000 that your initial investment has grown to. On the $4,000 that you withdraw, you will owe income taxes. The money you invest can pretty much be in anything, whether it's in stocks or gold or even crypto, but you do get a tax cut whenever you invest into this account, and then you have to pay taxes whenever you're old enough to withdraw the money. There are a lot of special rules for IRAs, so I highly recommend consulting a professional regarding this. Next, let's move on to the Roth part. With a Roth IRA, the taxed part is flipped. So when you invest $5,000, you pay taxes on it today, and because of that, you don't get a deduction from your yearly income. However, whenever you retire and that initial investment has grown to $20,000 and you want to take out $4,000, you don't have to pay any taxes on the money you take out. Now I know this is a little confusing, especially if this is your first time hearing of it, but the main difference between a Roth IRA and a traditional IRA is when you pay your taxes. You either pay them now or later, and there's technically is not an advantage to either. You'll end up paying the same taxes if you're in the same tax bracket when you invest and when you withdraw. The trick here though is that if you think you're going to be in a higher tax bracket whenever you retire, you'll want to deposit in a Roth IRA to save money. On the other hand, if you think you'll be in a lower tax bracket, the traditional IRA is more advantageous. Anyways, I probably should make an entire video on this topic, so leave a comment below if you want a video on this. IRAs aren't really in the crypto space, but according to the recent comments, I'm pretty good at explaining stuff like this if I dedicate some time to it. Let's get into actually where the crypto part comes in. Remember how I said you could set up a crypto IRA? Personally, next year, I will be setting up a crypto Roth IRA so that I can buy crypto and use it as my retirement account. There is another advantage to a Roth IRA, and that is that it can technically be a savings account. So let's say you put in $6,000 this year and $6,000 next year. You'll have $12,000 total deposited. Since that initial $12,000 has already had taxes paid on it, you can take up to that much money out of your account for any reason at any time. Personally, I will keep depositing money into this account until I'm like 55 or 59 or whatever the eligible age is when I get that old, and then I can withdraw money from this account tax-free, since it technically already has taxes paid on it. Right now, I think there's a $6,000 yearly limit on your contributions, and this stuff can get complicated. So don't use this video as financial advice, but more as an arrow pointing you to talk to a professional about this stuff. I'm just saying, as a crypto-based retirement account that can act as a savings account, which also is beneficial to my future taxes, I thought this was something that needed to be on this list. If you thought that was complicated, let's get into the next one, which is called a charitable remainder trust. Now this is a very advanced strategy that you'll definitely want to reach out to an accountant or a lawyer for. Maybe even a few, and it is mostly used for accounts with over $500,000 of crypto. In fact, this is probably best for people who bought Bitcoin a few years ago and are now sitting on a big pile of unrealized cash. Let's get into it. So the first thing in this strategy requires setting up a trust called a charitable remainder trust. Once it's created, with the help of a professional, you will actually gift this trust your crypto. Now there's no tax that you have to pay whenever you give a quote charity your crypto. In fact, you actually get a tax deduction from giving that gift. There's a limit to that, but I believe it's around 30% of the total donation. After you've done that, the next step is for your charitable trust to sell your crypto so that it now has cash. So now you do not own any crypto, but you also don't owe any tax. Then the trust has your crypto, but it sold it. So now the trust has cash. But it also hasn't paid any tax since charities don't really pay tax. The next step is to set up a fancy thing called an annuity, which is basically a word for passive income. The Charitable Remainder Trust annuity can pay you up to 7% of its value each year as an annuity. So if it has $1 million, it can give you like $70,000 per year. Now the charity isn't taxed, but you are taxed on the $70,000 that you get from the annuity. But Theodore, you said this was to avoid taxes. You're right. You didn't pay any long-term or short-term capital gains tax, and now all you owe is income tax. Well, remember how I said you could deduct around 30% of the gift on your taxes? Technically, you can split up this deduction between a 5-year period. So 30% of $1 million is $300,000. And then if you split that deduction up between 5 years, you get a yearly deduction of $60,000, meaning you earn $70,000 from the annuity with a $60,000 tax deduction. So you technically only have to pay taxes on the $10,000 difference. So basically, you effectively avoided or transferred your crypto tax into income tax, and then also created an entity that will basically pay you for life. Here's another bonus. If you want, you can set up a life insurance fund with the initial annuity payments, and you can use that to super fund it in a way that the amount of the initial investment, or $1 million, goes to your spouse or your family or whoever you want in the case that you die, which means your family also won't owe any taxes on this money. One more big benefit of this is that it's technically asset protected, which means even if you declare bankruptcy or you get sued out the wazoo, nobody can touch this money or the annuity that is paid to you. Wrapping this up, I'll be honest with you. 99% of you watching this, you will not need this strategy. Yet, but you might. I'm probably oversimplifying it as well, but if you Google how to avoid crypto taxes and found this video, I'm here to point you in the right direction. I'll share a video in the description below of an actual professional explaining it very well if you want to look further into it. Next up, let's talk about leaving the United States, because if you're a crypto millionaire in the United States, something you might consider doing is leaving the United States. Since capital gains and income tax in the US could easily eat up over 50% of your gains, it might be advantageous to consider moving to a different country. Puerto Rico is a common country to move to since they have a favorable crypto tax laws and a decent overall tax rate. Now, one rule here is that if you're already a crypto millionaire and you're leaving the US, you will probably still owe taxes to the US. Another technicality is that you actually must live in Puerto Rico for at least 183 days per year to get the most of the benefits. There's a few other countries I can mention that you might consider moving to, but honestly, again, this might be worth an entire video of me researching them and discussing the pros and cons of each country, so we're going to go ahead and move on. Lastly, I want to talk about tax evasion. Like I mentioned in the beginning, evading your taxes is using illegal methods to avoid paying your taxes. These are not clever loopholes, but more outright stealing money that is owed to your government. I cannot endorse actions like these, but I also can't help but share with you some examples. This way you know not to do them. Please don't do these probably illegal things that will allow you to get out of paying taxes on your gains. The first one is buying something from a place that doesn't require KYC. For example, if you were to go to bitrefill.com and purchase some gift cards to popular places like Amazon, technically, BitRefill does not report to the IRS, so the IRS wouldn't know that you realized your gains, which would technically be a taxable event in the US. If you didn't report this, it would technically be tax evasion. However, there doesn't seem to be a way that the IRS could easily find this out. They are working on crypto tracking software, so this could change. Next up is Newegg. Newegg is another popular online store that allows you to buy electronics like computers, computer parts, dishwashers, and a bunch of other big high-ticket items with crypto. Now, a real money-laundering, tax-evading crypto fool could make an entire business out of buying these things and then selling them for cash. But again, this is very illegal, and the longer you did it, the higher your chances of a 3-letter agency knocking on your door. Something else that is iffy that is worth putting on this list is gifting to your friends. I think the rule is now that you can gift up to $15,000 to someone and you don't have to report the gift. So theoretically, you could give $15,000 of gains to your friend and then not report that. And then you wouldn't have to report that you technically sold these gains to give them to a friend. Then your friend could cash out these gains as if they just bought them at market price, claiming zero capital gains tax, but simply an income tax, which might be lower for some people. It would definitely be illegal and probably immoral to use your friends like this, but it is one way you could get around paying the full tax bill on your crypto gains. Lastly, I kind of want to mention my plan. So personally, I plan on holding long enough that one day I can either move to a country that doesn't care about crypto taxes, or that crypto will be so mainstream that they won't want to collect taxes on it anyways. This way I can use it for everyday things without worrying about capital gains tax. Now I know this is risky, but it helps me keep a long-term vision on my portfolio and my other larger crypto decisions. Either way, I definitely keep good accounting of my purchases and trades, so that if the laws are similar to what they are today, I'll be in the clear. Anyways, if you want to learn more about actually making money with crypto, I actually have a free course that literally over 10,000 people have already went through and I think loved, and I'm still giving it out for free. So just go to whiteboardcrypto.com, you enter your email, and you'll sign up for our newsletter, get a link to join our free Discord, and of course, be able to go through the free Decentralized Finance course. Wrapping up this video, my throat's getting a little sore, so I hope you enjoyed this video. I really hope that you've learned something, and most of all, I hope to see you in the next video.